Hey everyone, it's Brandon here. In this video, I'd like to share with you Tuatera's framework for determining fair practice valuations or prices inside of partnerships. As you hopefully know by now, we at Tuatera are very passionate about partnerships and see the formation of effective partnerships as one of the primary vehicles or mechanisms in which dentists can compete in the consolidating industry against the big DSO behemoths. But there's a lot of inertia or misunderstanding or even negativity towards partnerships in the industry. Some of that, maybe even a lot of that, is born from the industry really being set up to support transactions and not partnerships. And some of the help or the support that is needed to form an effective partnership is not always easy to find. And one of the areas that we get lots of questions around on both sides when we are trying to help form partnerships is, how do you determine a fair price to be paid by the buyer when buying into the existing practice? So we're going to walk you through here in this video a framework that we use that will help give some better context to how to think about the price of the practice or the equity inside of your partnership. I'm going to start off by talking about how partnerships really are different from transactions. So we're going to do a little compare and contrast exercise here. And the big takeaway that I want you to have from the following couple of minutes is that the importance of quote unquote the perfect sales price, to the extent there ever really is one, for the practice equity, the importance of that is significantly different in a partnership versus a transaction. Now, to be clear, when we say transaction, what do we mean? We mean selling more than 50% of the equity of your practice. So you're selling a controlling interest. Sometimes that's 100%. That's clearly a transaction. Sometimes you might be selling 60%. Often that would be in a DSO transaction where the doctor might sell 60% and maintain 40%. Even though in that case they haven't sold 100%, because they've sold more than 50%, it is considered for our purposes here a transaction. Inside of a transaction, the sales price is often the thing that both sides focus on, and they focus on it with different aims. The seller wants to maximize the sales price, especially if they're selling 100%. This is their last opportunity to monetize what they've created. And the buyer has the exact opposite goal. They would like to minimize the sales price. With the transaction, dual representation is problematic. In some of the forums that we hang out in, we see this question posed quite often about whether or not dual representation can be done and can be done effectively. Usually inside of a transaction, dual representation is going to be problematic. As I said a moment ago, that largely comes from the fact that sellers and buyers want to do different things with the price, and the price is usually the main focus. Oftentimes as well, a broker or a valuation company is engaged also as a broker, and they're going to be paid a percentage of that sales price, which means a higher sales price equals a higher commission for them, and that creates a conflict of interest. In that case, it makes it really difficult for the broker to truly represent the buyer, because as stated in point number 1, the buyer's objectives might be to push the price of the practice down, which is in conflict with the seller and therefore the broker's objectives to some extent. And then I want to point out that in a transaction, the buyer can, and they often will, pay what we call a control premium that reflects the value that they, the buyer, place on being able to shape or change the practice as they desire. That could be that they have aspirations to grow the practice, change the standard of care, implement new equipment, change the carpet. It could also be more strategic, such as in a DSO transaction, where they expect to negotiate lower supply costs or higher PPO reimbursements. So in those cases, when engaging in a transaction, buyers can often receive more compensation than their practice is really worth, because it's going to be the buyer that creates the additional value, and the buyer uses that additional value to share a little bit with the seller so that they can offer a higher price than other potential buyers. But the practice wasn't really worth that in the hands of the seller, and that's why we call it a control premium. Now let's take a look at partnerships. And as it's probably clear by now, we're not diving in on this video to all of the nuances of partnerships and transactions, but just comparing them high level before we dive into the more specific framework that we have to share with you. In order to set the context here for partnerships, I want to draw your attention to some numbers. In a 10-year partnership of, say, a $2.3 million practice, and we understand that to be a relatively average partnership consisting of two doctors that are probably not even operating but 3 to 3.5 days per week, because that's also part of the benefits using a partnership, is that if done well, both doctors can often step back a little bit clinically, because the profit margins of the practice allow them to earn additional owner profits, and they make about the same, if not more, than they were as solo practitioners. But in that 10-year partnership, the partners will share an economic pie of about $12 million. Also, for our purposes, any partnership, quote unquote, that has an expected life of less than 10 years, it's probably not a partnership the way that we define that at Tuatera, and it's probably really a succession plan for the older doctor. Nothing wrong with that necessarily. Just want to be clear that we're not talking about succession plans. We're talking about partnerships. 10 years is the minimum for us. And some of the clients that we've supported in this process, whether it's because they have a longer partnership timeline in mind or they're a bigger practice, we've seen economic pies greater than $20 million. Now, inside that total economic pie, the transaction value that we were just talking about with inside a transaction is the thing, is only going to compromise about 15 to 20% of the total economic pie, or about 1.6 to $2.4 million based on ranges of what that practice might sell. And what we call the relationship value, or the ongoing income opportunity that the two partners have, will represent 80 to 85% of that overall economic pie, or greater than $10 million. We use that to help you keep your eye on the prize in a partnership. That even though the sale price of your practice equity, whether you're the buyer or the seller, is important, it is not the most important or meaningful thing inside of a partnership. And we think these numbers can help give you that context. So as we did before, let's clarify what we mean by a partnership. I already explained that we consider anything less than 10 years to be a succession plan, not a partnership. A partnership means the sale of less than or equal to 50%. So again, a transaction is more than 50%. A partnership is up to 50%. Oftentimes in our framework, we advocate for two different tranches, whereby the partners will first enter into a 75-25 for a number of years, and then a 50-50. They'll operate as 50-50 for a period of time, and then whether or not the original seller sells the rest of that 50% to the buyer, or the original buyer that is, or finds a new partner, there's some flexibility there. So as we were saying with the numbers, in the case of a partnership, and this is from a financial perspective, the future earning potential, or that $10 million of relationship value, which is a product of having a unified vision that the partners would establish together, that becomes the thing. And in this case, both sides want to maximize that. So contrast with in a transaction, number one, the actual transaction value is the thing, and we have the buyer and the seller's goals in conflict. In a partnership, the transaction value is important, but it is clearly not the thing. The future earnings potential is the thing, and both partners are working to maximize that. They're both on the same side of the table for this. In contrast to transactions, we think dual representation, and I have that in quotes for a reason, is necessary. And that when it comes to partnership consulting, the partnership is the client. Forming a successful, mutually beneficial relationship between two doctors is the client. Neither the seller nor the buyer are the client when we engage in our purpose-driven partnership framework, but it's the partnership that's the client. I mentioned that representation was in quotes because unlike transaction brokers that are selling your practice, partnership consultants should never be paid a percentage of any sales price, a percentage of any economic pie, but should be paid a fixed fee on par with the value that they're bringing to the partnership consulting. And then the buyer cannot and should not pay a control premium precisely because they will not be in control. So in contrast to a 100% sale or majority sale, where the buyer has the right to change the practice as they see fit, and oftentimes buyers believe or they're optimistic they will be able to significantly improve the practice, that opportunity is not being offered to a partner. Whether you're bringing a partner in at 25% or 50%, the senior doctor, the seller, is not relinquishing control to the junior partner. And then more so, even if they're 50-50, the senior doctor has the inherent or the implicit control in the practice for some foreseeable time because they have the longer relationship with the staff and the vendors and the patients. So the buyer can't pay that control premium. So it's possible, if not likely, that we have different prices that could be paid for the same practice depending on the percentage that's being sold. Some people talk about this as a minority discount. We're talking about it as a control premium. So with that background, let's talk about a fair mechanism to put a number on the practice equity, because we have to do that we believe is equitable to both the buyer and seller and keeps both partners focused on the bigger piece, the ongoing relationship value, and creating that unified vision together. So while we do want the senior doctor or the seller to be paid equitably, we also don't want the buyer to overpay or underpay. We really want to do something here that is equitable to both parties and is fair. And both parties, again, can feel good about that number, but then focus on the bigger picture and creating a long-term together. This is very important because as the relationship unfolds, if either partner starts to feel that the practice price was done wrong, like materially wrong, a little bit of resentment can grow. Maybe economic aspirations that they had are not coming to fruition, and they do some studying and they realize maybe that they agreed to a number maybe they shouldn't have, or a mechanism that they shouldn't have, and then that can throw a wrench into the relationship. And what maybe was a $50,000 problem becomes a $500,000 problem as the partner's relationship starts to deteriorate. So whatever method you choose, because this is going to be an ongoing relationship, it's very important that both sides feel good about it. Now, from Tuatera's perspective, in many cases, but not all, to be clear, A formal valuation is usually not needed to support a partnership buy-in. There's a couple of conditions that I want to show you when that's the case. There are situations in which you will maybe determine that you'll want to obtain a valuation. So what I'm about to show you is not mutually exclusive. You can do both, or you can incorporate the two methods or multiple methods that I'm about to show you, as long as you follow a clear process in doing that. But for most, and I would estimate maybe 75, 80% of practices, maybe more, don't need to engage a formal valuation for a partnership buy-in, but a couple of conditions should probably be true in order for you to skip that step. Number one, assets and equipment should be of moderate age, neither very brand spanking new nor dilapidated. The method that we're going to talk about, which is the EBITDA method, assumes that the business makes a rather consistent investment in fixed assets and equipment. To the extent that that's not true in either direction, because the assets are really old and the buyer is going to have to invest heavily the first few years of owning the practice or being in the partnership, then there's an adjustment that might be needed there. The inverse is true. If all of the assets are brand spanking new and the buyer's not going to have to make any investment for a number of years, then an adjustment might be needed there as well. The seller or the senior partner should already have clean, accurate, and understandable financials. In order for a buyer to be able to purchase an interest in your practice without needing to rely on a formal valuation, they're going to need to be able to leverage a CPA resource, most likely. And in order to do that, you as the seller are going to need to be able to provide the buyer with accurate, clean, timely financials. If you can't do that, you should start working on that. That's the critical component in selling your business. And oftentimes, that's one of the reasons that valuations take so long and they cost so much, is that the seller or the senior doctor does not have clean, accurate, and understandable financials. And the broker or the valuation company has to do a lot of work to really understand the profitability of the practice. Another example is discretionary owner expenses. So if you are employing tax strategies, some of the popular ones such as employing your spouse for retirement, employing your kids to help with educational funding, renting your home to yourself, running a lot of travel expenses through the practice, it's very important to separate those items in your financial statements from the rest of your practice. The Tuatera accounting framework does that for all of our clients. You want to take care of things like that outside of and before evaluation process if you're hoping to skip evaluation. And then third, major expansion projects such as moving the practice should really only happen after forming a partnership. So if you have recently moved your practice and substantially changed it versus the couple of preceding years, then you might have to do a little more work to hire someone to value that. In our purpose-driven partnership framework and what we call the expansion curve, we really advocate for doctors to find the right partner first and grow in their current location as much as they can, or with minor expansion projects, then form a partnership, and then do a major expansion afterwards. Nothing wrong if you've had to expand your office a little bit to make room for an associate that now is this person you're talking about being a partner. We're talking about major expansions. So if you find yourself in a scenario that you can't check the box on these three and you think you need to incorporate a formal valuation, we have a couple of recommendations that when valuations are needed, that you should consider doing them with the following conditions. Number one, consider agreeing to a price that is subject to a floor and even possibly a ceiling before engaging with the broker. You would do that, as I mentioned a moment ago, These methods do not have to be mutually exclusive, so you could go through the EBITDA method that we're going to share with you and at least get a really good idea of where the practice will probably sell for and agree to a floor and a ceiling, and then you can use the valuation to get more precise. If you find yourself obtaining a valuation and you literally have no idea what your practice is worth, you're probably doing something suboptimal here, and you should work harder to understand your financials and the EBITDA. This is also an important mechanism to facilitate the next piece, which is dual engagement. In order to effectively incorporate a valuation inside of a partnership, we need to work to eliminate the conflict of interest that we spoke of earlier. And about the only way to do that is have a dual representation or dual engagement where both parties, that includes the current associate, to be clear, would actually pay for a pro rata share of the valuation. We think it's effective to be able to communicate to potential valuation companies that you've already agreed to a floor and a ceiling. You don't have to and probably shouldn't disclose to them what that is, but letting them know that you and your partner, your potential partner, have already done some work and already have some basis of understanding. And that's one of the reasons that you both feel good about hiring them to be dual engaged, so that they can feel good about that too. A note for the associates and I suppose the owners, we do think the only way to get a valuation that might be neutral is if both parties pay for it. If you are offering a 25% buy-in, then perhaps the valuation should be paid for 75% by the senior doctor and 25% by the junior doctor. If the intent, though, is that you're on the road to 50-50, you could also negotiate sharing the cost 50-50. So no wrong answer, except that the associate or the potential partner must pay some material amount of the engagement to be able to consider it as dual representation. We think it'd be helpful to provide some clarity that broker services are not needed here, that you've approached the broker with no interest to sell your practice in a transaction or hear about that or hear about EBITDA multiples and selling prices and some of the transactions they've done, but that you just need a valuation because you have this partnership you want to execute and there's no amount of money in the world at this point now that can change your mind on that. And to that end, we would encourage you to consider avoiding companies that you know actively participate in the DSO market. What can happen, using the last 2 points, is that for brokers that actively participate in the DSO market, meaning that they have potential buyers on speed dial, a 2-doctor profitable practice is a very, very appealing target in the DSO market. And it could be very tempting for the broker to want to, or the valuation company to want to let you know what's happening in the DSO market before you ink this partnership. Because once you ink the partnership, you probably can't sell this practice without the approval of the other partner. So they might want to make sure you know about this. If you have any doubt about whether you'd want to be in this partnership versus sell to a DSO, you need to do that before you are this far in the process. Odds are your associate, your potential buyer, is very clear that they do not want to work for a DSO, and that's why they're pursuing this partnership with you. And your relationship can go sideways quickly if you, the owners, start entertaining a DSO offer at this point as a recommendation from your broker. Note that DSO companies would want to lock up your associate anyway, so you run the risk here of the broker trying to get you excited about a DSO sale and alienating your associate, losing in the process. Why would a broker do this or have a reason to do this? As I mentioned earlier, brokers get paid a percentage of commissions on selling a practice. Sometimes in the DSO space, that is a really, really large number based on the price that they could sell your practice for. Oftentimes the brokers are paid on the total transaction value, even if Some of that transaction value is not paid in cash, but is in equity. So it can be very tempting for them to see your business as a way for them to monetize and achieve their outcomes. So you got to be careful of that. And then another one is that a lot of times, if not every time, when you have a valuation done, the valuation company will do their own research on what they believe is market compensation. And that is starting to get more nuanced than ever before. Again, because of the DSOs, we have a wider range than ever before on what is considered market-based compensation. It's our belief at Tuatera that inside of a partnership, that the valuation should really be connected to the partner's planned income allocation formula. And the income allocation formula will specify the amount that the partners are to be paid in terms of percentage. For example, you have agreed to, and maybe because you're going to use what your associate's already making. So your associate is currently making 32% of net production. So you've agreed that you will keep using 32% for both of you. Once the buy-in occurs, you should pass that percentage along to the valuation company and have them incorporate that in, or, because sometimes they won't, you would let them know and document that you and your partner have agreed to use that, and that for the purposes of your partnership transaction, you will make an adjustment for any compensation percentage used by the valuation company that is different than that 32%. Valuations, one final note there. Valuations are technically performed buyer agnostic, and that's why the valuation company will often default to let us do the market research on what clinical compensation is. As we said from the start here, though, partnerships are different than transactions. The only reason we're even having a transaction in this case is in the context of a partnership. We're not buyer agnostic. The buyer is clearly known. We should go ahead and link the sales price and that transaction value to that relationship value, which is where that clinical compensation comes in. We really believe it's important to connect those two. But for many partnerships, evaluation, as I said, is probably not needed unless you have these set of circumstances or you want to further validate the numbers you're thinking, things like that. An evaluation method based on EBITDA can be utilized. And doing that might allow you to not only achieve a fair outcome, but save time and some money in conducting a formal evaluation. So now we will dive into the EBITDA approach. It's important to spend a minute unpacking what does EBITDA mean. The official definition of EBITDA is earnings before interest, taxes, depreciation, and amortization. But for all intents and purposes, that's just a fancy way to say owner profit or owner cash flow before debt service and asset purchases. That's all you really need to know, is that EBITDA is the owner profit. Couple of things. When I say all you need to know, you don't worry about remembering what the acronym means. It really doesn't matter. Just know, again, it means owner profit before you pay your debt and before you spend money or cash on big asset purchases. It is important to know that EBITDA, or again, owner profit, is only after you pay yourself as a clinician or an associate. So a moment ago, I mentioned that maybe you've agreed to pay yourself and your associate 32% of production as partners. Well, we can only calculate the EBITDA after we consider that 32%. I want to make a note that most of the dental industry, at least 99% of the clients that we work with, they utilize debt to pay for any significant assets or equipment purchases, because bankers love dentists and they happily lend, and often even when interest rates are high in general, banks or suppliers will give decent financing. So we're not going to talk a lot about asset purchases in terms of cash flow, because most practice owners are not making six-figure asset purchases with cash. Most owners, if they're buying and panos and 3 new chairs and things like that, they're using financing to do that. So we're going to focus on debt service when it comes to EBITDA and cash flow. It's important to note that your debt is paid from EBITDA. So, as I said at the start, EBITDA is a fancy way to say owner profit or owner cash flow before debt service. You take your EBITDA then, and you have to pay your debt service with your EBITDA. So what you're left with then is your net cash flow. So net cash flow is what remains after you pay your debt from your EBITDA. Let's take a look at an example. This comes right out of our QFR EBITDA reporting. For those of you that have watched that video or familiar with our offerings there, and you'll note as we were just walking through that EBITDA includes a call out for the associate or owner doctor comp. So you can see in this example, the owner has paid themselves, quote unquote, approximately $372,000 if they were compensating themselves as an associate. And we do that before considering the EBITDA. And the EBITDA ends up at $334,000. From that EBITDA then, and what you see in the bottom 2 sections, the owner has to pay their debt service. So that $334,000 first, they use that to pay $114,000 of debt service. And you can see that's about 34% of their total EBITDA. So about 1/3 of their EBITDA was going to pay off their loans, which means the remaining 2/3, or about $220,000, is their net cash flow. One more time, EBITDA is calculated after considering the owner's doctor or clinical compensation. So you can see once again that this owner is estimating, this is just an estimate in this case, that their clinical compensation would be about $372,000. Their EBITDA of $334,000 considers that. Then their EBITDA is broken down between their debt service and their net cash flow. And about, in this case, about 1/3 or $114,000 of their EBITDA went towards debt service or loan payments, leaving them with about 2/3 of net cash flow. Important that you understand those terms there in regards to EBITDA and debt service and net cash flow. As we shift gears, and we're going to do a walkthrough of our framework where you can see in more detail why we are confident that in most situations, 2 potential partners could use an EBITDA framework that would be quicker and many times maybe more equitable than a formal valuation. You can have really good peace of mind about that. And so we're going to walk you through that now. What you should be seeing now is our framework for fair practice valuations using the EBITDA method. We're going to walk through the EBITDA method in detail, and then we'll compare and contrast that a little bit with the percentage of collections method. Make this a little bit bigger for everybody to see. As stated here, we believe that the EBITDA method is often optimal for partnerships. What we're going to demonstrate, we're going to walk through here how the EBITDA method results in a consistent return on investment for the buyer, rewards the seller for the practice they've built, and ensures that the buyer can sufficiently pay for the note. And then we're going to contrast that versus the percentage of collections method. It can result in a lot more volatility and a lot more uncertainty on both sides, quite frankly, and in many cases would be suboptimal. To best demonstrate the approaches here, we're going to look at 5 different scenarios and a practice that ranges from same practice, about $2.5 million in revenue, which again we think is in the ballpark for what most partnerships might be looking at in terms of total revenue, with EBITDA ranges from 5% at the low end to 25% at the high end. Hopefully you won't be dealing with the low end here, and we'll only be talking about higher profitable practices, but for illustrative purposes, we want to walk you through that. The way the EBITDA method works is that it's based on a multiple of EBITDA. So over here you can see we're recommending 5 times. So not only are we recommending you use the EBITDA method, we're specifically recommending that you use a multiple of 5 times. In the case of a $2.5 million practice at 5% EBITDA, the EBITDA dollars would be about $125,000 a year. Multiplied by 5 would yield a sales price of about $625,000. You can see that even though revenue does not change, that as the profitability of the practice increases, so does the sales price. What's really, I think, fascinating about this method, though, is that even though the price increases substantially as the revenue doesn't change based on the profitability percentage, the buyer's cash-on-cash return stays consistent and is always consistent with the EBITDA method based on the chosen multiple. So notice that 20% is the inverse of 5, 1 divided by 5, right? So the seller enjoys a 5% or 5 times multiple, and the buyer enjoys a 20% cash-on-cash return. And we're actually going to use the buyer's perspective, maybe a little bit more than the seller's perspective, to feel really good about this price or this mechanism for everybody. Cash-on-cash return is not necessarily a term that's talked a lot about in the industry, but we think there's some really good value in understanding what that figure represents. Because cash-on-cash return, similar to EBITDA, allows you as the potential buyer to compare the opportunity of owning a dental practice with other financial investments, whether that is owning a piece of real estate, investing in the stock market, or investing in another business such as a franchise. We can look at different opportunities and we can look at the cash-on-cash return that's typically available in those investments to feel comfortable and good about this 20%. In real estate, for example, there's often a cash-on-cash return or goal of maybe 8 to 12%. Real estate, from an investment standpoint, might be at the lower end of a cash-on-cash return on an annual basis, because it can offer some appreciation opportunities, and it's an asset class they're not making more of, and it has a bunch of tax strategies with it as well. Next, you might have the stock market. Stock market historically provides about a 10% annual return on investment, but if you invested in the stock market, you know there can be a lot of volatility there from year to year. Finally, we'll look at what we know about the franchise market. So this would be people that are looking to own a restaurant like a Dunkin' Donuts or Panera Bread or McDonald's. 15 to 25% is a range we've seen cited as expectation of buyers for cash-on-cash return in that industry, and that range is dependent upon the risk and the opportunity. Some franchises are more proven and their industries are more stable. Dentistry, we think it's fair to say, is a stable industry, but it's also an industry that has limited buyer pools because of the educational and licensure requirements of the buyers. But when we put those two together, we think it is fair to provide buyers with a cash-on-cash return of 20% that's in the middle of that 15 to 25% franchise range that I was referencing. So again, there's power from the buyer's standpoint of thinking cash-on-cash return, so they can compare this investment opportunity to other opportunities. Now note that what is not consistent in this method is the price as a percentage of collections. That even though the buyer's cash-on-cash return is always the same, the price of the practice as a percentage of collections can differ greatly. Because a method based on EBITDA rewards higher profitability percentage because the buyer ultimately buys the cash flow from these practices. I think it's fair to say that a $2.5 million practice that's generating $625,000 of cash flow for the owners is not the same as a $2.5 million practice that's only generating $125,000. That's what the EBITDA method recognizes, that the percentage of collections method does not recognize, which we'll cover in a moment. Now, with that overview, we want to dive into some specific numbers so that you can really understand how this method results in outcomes that are equitable to both sides. So what we're going to do is we're going to analyze the cash flow, so how that EBITDA would be shared between debt service and annual net cash flow after debt, given these scenarios. We're going to use 120 months or 10 years to evaluate this because that is the time period that most banks are using for practice acquisition debt. If you're doing seller financing, that's often what we'd recommend as well, so that you're on par with banks. Interest rates, at least today, I think it's reasonable to call 4 to 7% a reasonable range. While we have some clients with loans on the books under 4%, I'm not sure that we'll ever see that again in my working lifetime. And note over here to the side that the 10-year Treasury yield long-term average is 5.85%. That is the market that drives 10-year banknotes. So, many historical or long-term averages are probably in this range here, 5 to 6%. So what we're looking at is how the EBITDA, so whether it's 125 or 625 that you're buying, is split between debt service and cash flow. Here are the actual numbers, and then here are the percentages. So when using an EBITDA-based method, the percentage of EBITDA, and this with this given amount of revenue, that is dedicated towards debt service is always between 60 and 70%. That's pretty consistent. If you think about this matrix represents substantially different prices ranging from 600,000 to 3 million, and substantially different interest rates ranging from 4% to 7%. All of these scenarios, though, only range from 60 to 70% of the EBITDA paid towards debt service. So it's very, very consistent. Something else that you might take away from this is that while interest rates do matter, they probably don't matter as much as we make them out to. And we'd encourage both sides in a partnership, especially if you're incorporating seller financing, to lean in, if you will, and not attempt too hard to maximize the interest rate or minimize the interest rate, because as you can see, within a range that we'd expect most seller financing to be in between 5 and 6%, it's not astronomical dollars in either direction. On page 2, we have the same information at the top, so this is exactly the same, but this time we're looking at the annual net cash flow after you pay that debt. Once again, here are the numbers, but I'm going to focus on the percentages. And here you see that between 40 and 30% is what is always available as net cash flow using the EBITDA method. So to the extent that the EBITDA number that is utilized is accurate, and that is key, and we're not going to totally dive into that today, but to the extent that that number is accurate, then buyers are essentially assured that they will be able to positively cash flow any loans, whether it's internal financing or bank financing, that there's essentially no risk of them defaulting or not making some additional money as an owner following the 5 times EBITDA method. As many owners probably already know, the additional net cash flow when you're paying substantial debt is not necessarily life-changing depending on the size of the practice and depending on your associate income. For bigger practices, it certainly is. For smaller practices, if your associate comp is in the $300,000 range, for example, these are nice. This is a nice to have, don't get me wrong, but this might not really move the needle for you until you grow the practice and you pay that debt off. But the point is, you'll never run the risk of losing money on the transaction when using a 5 times EBITDA approach and having an appropriate EBITDA base. For the EBITDA base itself, I mentioned earlier that we believe sellers should have clean and accurate and understandable financials already. We believe that for the most part, sellers should use unadjusted EBITDA, and that it is not appropriate in a partnership to attempt to make many adjustments to EBITDA unless you can really prove that you have some changes in motion. Again, contrasting to a control sale, and I mentioned a DSO where the DSO might plan to change your supplier and renegotiate your reimbursement rates. The new partner coming in is not expecting to do any of that, so it would be unfair for the seller to make a bunch of adjustments suggesting that they would find all of these savings opportunities after they bought in. If your financials aren't clean, it's better to clean those up and get your recurring financial statements organized so that you can use those in your EBITDA calculation as opposed to having to make a lot of adjustments. The more adjustments you make in your EBITDA, the more you're going to erode trust on the buyer's side. So once again, the EBITDA number, it does need to be appropriate. We advocate for using essentially unadjusted EBITDA from the seller's financials. We do want you to consider using the right compensation that you've agreed to, and you need to pull out owner discretionary items, things of that nature, but sellers should avoid attempting to make the kind of adjustments that are typically made in transactions. Now let's contrast to the collections method. And why we're doing this is that often this is the method that is used directly or indirectly in formal valuations. If you're going to use an EBITDA method, as I just outlined, then you probably don't have to engage a valuation company at all. There are some firms out there that are doing valuations or analysis based on EBITDA for those practices that can't do it themselves. The two-a-terra reporting frameworks will position you to be able to do that yourself. So we're really talking about valuation companies not using EBITDA. They can indirectly use the percentage of collections method because often they will attempt to pull comparable recent sales transactions, and a lot of those might have used percentage of collections. And so directly or indirectly, the percentage of collections method might make its way into a valuation. The point of saying that is that valuations aren't always better or more accurate than the EBITDA method, and in many cases they're going to be less accurate. So know that just because you're obtaining a valuation does not make it more accurate than what you might be able to determine on your own. Using the EBITDA method, again, as we said earlier, we think you should really have a specific set of criteria that would warrant pursuing a valuation. So that's what we're going to go through here now is the collections method and some of the watch-outs that can happen if you're using this method. And again, this is what we'd expect you to potentially have incorporated into a formal valuation. Once again, we have the same practice range we were looking at before, $2.5 million revenue practice, ranging in EBITDA from 5% to 25%. But in this case, we're going to set the price in all scenarios at 75% of collections. So note that the EBITDA percentage has no bearing on the price. Okay? We are keeping this a little simple for this example. We have seen valuations that will do an EBITDA method and a percentage of collections method and attempt to combine those or average those out. But in this case, we're assuming a pure percentage of collections method, so the EBITDA percentage or the profitability of the practice has no impact. So the price of the practice is always consistent regardless of the profitability level. That's what you see here. The result of that, in contrast to the EBITDA method, is that the buyer can have extreme volatility in their cash-on-cash returns. And let's talk about this in the context of what we said earlier. At the low end, so if the buyer pays $1.8 million for this practice, they'll have a cash-on-cash return of only 6.7%, and that's lower than real estate and stock market and other investments that have less risk. So typically, if we're taking on an investment that has more risk and more effort, such as owning a business, we'd expect a higher return than asset classes of lower risk. If we look at the other extreme, if the buyer is able to pay $1.875 million or a fraction of that, so if we're selling 25% or 50%, they'd only pay a fraction of that, but for simplicity's sake, we're just looking at the whole practice, even though this is a partnership and we're not contemplating selling the whole thing, but keeping it simple. In this case, the buyer would enjoy a 33% cash-on-cash return, and that's higher than the 15 to 25% range that we noted earlier. So that's probably also not appropriate. Things get a little bit more palatable as you get closer to the midpoint. And then notice when EBITDA is equal to 15%, that we get a 5 times multiple when we use 75% of collections. Because the inverse of 75%, when you divide that by 5, you get 15%. Okay, so if you have a practice with mid-range profitability around 15% EBITDA, then the 75% collections method and the 5 times EBITDA method will generate the same result. But note that that's the only place it overlaps. As profitability deviates, either that it gets lower or it gets higher, somebody is probably getting a good deal and somebody's getting a bad deal. In the case of a low profitability practice, the buyer only has a 6.7% cash-on-cash return, and the seller gets paid a whopping 15 times EBITDA. That means that the buyer has to work for 15 years before they break even. On the high end, it goes the other way, where the buyer enjoys a whopping 33.3% cash-on-cash return, and the seller only enjoys 3 years. They're only paid 3 years of earnings for their life's work. And that's also doesn't seem really equitable versus, we're anchoring to 20% for the buyer and 5 years or 5 times for the seller. Once again, we're going to take this and we're going to run it through the detailed scenario using 120 months and the same interest rate that we were looking at before of 4 to 7%. And we're going to focus once again not on the dollars that are right here, but we're going to look at the percentage of EBITDA that's paid on the debt service and the percentage that's available in net cash flow. Notice right off the bat at the extreme end of this range that when profitability is low and I buy a practice based on the percentage of collections, I might be paying all of my EBITDA and sometimes even then some to the seller. I'm over 100% here when profitability is low. And then again, the inverse is true as opposed to paying about 60 to 70% of my EBITDA towards debt service using a 5 times EBITDA approach, which is right here once again in our mid-profit column. At the high profitability range, the buyer is paying much less than that towards their debt service, and they're enjoying that net practice cash flow. So let's take a look at page 2 and what that looks like. This time I'm going to look at some dollars. Now, this is probably an extreme scenario, but demonstrating some of the potential inequities and watch outs in the percentage of collections method. In this case, with this low profitability practice that's based on percentage of collections, the buyer could easily have negative to very little net cash flow. Okay? Buyers, even though they can't calculate this, in my experience, they feel it. They will notice when they get their first tax return. After being an owner, they're going to wonder, they're going to look at their W-2 from the year before when they were your associate, and it's going to be odd to them that they made less as an owner than they did as an associate when this happens. So if, again, this is where partnerships are different. Your associate who becomes your partner will know this occurred, and then the resentment can grow, and that's how they'll experience this, is that they'll notice that they're making less than they were as an associate, but now they have more risk and they have more work that they have to do. And from a percentage standpoint, you can see that net cash flow could be negative or it could be very, very small. As we showed you earlier, when profit is in the mid-range, then the percentage of collections method would match the EBITDA method, and you would get about 30 to 40% of net cash flow, or 30 to 40% of your EBITDA that's directed towards net cash flow. When the high profitability practice sells for a percentage of collections, you can see that the buyer then enjoys substantial net cash flow as opposed to 30 or 40% that we saw in the EBITDA approach. They're receiving 50 to 60%. So the takeaway should be that one of the takeaways is that the percentage of collection method, or a valuation that relies on the percentage of collections directly or indirectly, can result in extreme volatility, and it can be unpredictable. And what you can easily see could occur is that buyers and sellers could have a hard time agreeing on the valuation number itself, the company to use, because the outcomes can be so substantially different. One of the big benefits from the EBITDA method, if I go back, is the consistency, is that the buyer and the seller always enjoy the same returns by using an EBITDA method. The seller gets to monetize effectively 5 years worth of the current level of profit in the business, regardless of what that level is. And the buyer gets to enjoy a 20% cash on cash return. Buyers do not need to worry about the percentage of collections that they paid. It is okay to pay 100% or even more than 100% of collections if you're generating an adequate cash on cash return. This is one of the reasons why DSOs and private equity firms have pushed the sales price of practices above the historical 75, 80% of collections, and even some cases above 100%, because the DSOs and the private equity firms, they are focused on generating cash on cash returns, and they want to optimize that, and they want to be able to predict their outcomes so they can provide returns to their investors themselves. They are not concerned about the percentage of collections. As a buyer or a potential partner buying in, you should not be concerned about the percentage of collections. You should be concerned about the cash on cash return. And how you do that is by utilizing an EBITDA method. As I said during the presentation that we walked through before this, the EBITDA method and obtaining a valuation do not have to be mutually exclusive. And in the event that you use a valuation, we think it'd be best practice to go through an EBITDA method first and have an idea for both sides as to what the practice is likely worth, and use a mechanism such as this to decide a sales price. So for example, if I was selling this practice and we had reason to believe that the EBITDA was 15%, how do I get confidence in that? I'm following Tuatera's framework, I'm receiving their quarterly financial reporting, and I'm looking at my EBITDA on a quarterly basis and I have clean books. On an EBITDA basis, we are comfortable the practice is worth 1.875. We could probably use that, say 10 to 20% either direction. And we'd say, hey, we're going to go out and get a valuation to firm this up. But in no case can the practice be worth less than 1.6, and in no case can it be worth more than 2.2. But we've decided that we want to double check our numbers, and so we'll go out and we'll have a valuation performed, and maybe that valuation will come back and they'll say it's worth 1.843, $1,843,000, and they'll change the number by $30,000 only. That's not necessarily what we paid for. What we paid for was to feel good about it. We paid to double check that we don't need to make adjustments based on our asset base and things like that. And that's okay. But as I said earlier, we'd encourage you to let your broker or your valuation company know that you've already conducted an analysis of what you think the practice is worth based on an EBITDA framework such as this one. That brings us to the end here. As I said at the beginning, Tuatera is very passionate about facilitating more partnerships in the dental industry and being a resource for you in crafting that most meaningful relationship. Hope that you find value in this video.